we are running a little behind schedule, so why don't you start?
So, friends, we are going to start a policy panel. May I request Dr. K.V. Subramanian, Chief Economic Advisor, to come on the stage. Dr. Andreas, Bauer, Senior Resident Representative for India, Nepal, Bhutan, in IMF. So, now floor is open. Okay.
Inaugural session. I must thank the Vice Chairman from NITI Aayog to have presented his views in such an elegant manner and so systematically brought in the history of what economic reforms should be, what were they, and where we should be heading for. We now start the second session, which is the policy session. And in this policy session, I'm really very fortunate to share with you. It's just about 48 hours back, I went to the Ministry of Finance and requested Dr. Subramanian if he can come and grace this occasion. Such a short notice. And I'll be only able to do it a few minutes, but I would like to come and sit, deliberate, share my thoughts. Dr. Subramanian is the Chief Economic Advisor of our country, just taken over in the last week of December, PhD from Chicago Booth, earlier studies from Aayog, the most illustrious published author on banking as far as India is concerned. Leading journals has his articles. And because of paucity of time, we are requesting him to lead, present his thoughts, and then he will have to leave immediately because there are prior commitments. Following that, we have Dr. Andreas, who's from the International Monetary Fund, and he's going to share with us the details and cross-country experience. He's our resident representative in India. And then we have Marius, who's come all the way from the World Bank, Washington, DC, landed up here at 4 a.m. in the morning just to be with us. And he'll make a presentation basically about the financial sector, where his specialization is. And finally, the session concludes with a presentation from Ajit, who's been with the NITI Aayog. So I would now request our Chief Economic Advisor, Dr. Subramanian, to share his thoughts.
Good afternoon, ladies and gentlemen. Let me first thank Dr. Charan Singh for inviting me to what looks like an excellent conference. And I say that actually, I really mean it, because if you look at revealed preference, we look through the papers and we have a couple of my colleagues actually attending the conference just to, listen to some of the excellent papers. So, and thanks for those kind words as well. Let me just briefly share some of my perspectives on banking, on the banking sector. I think Dr. Rajiv Kumar set the agenda very beautifully, talking about some of the key issues. So I'll be building on some of those aspects. I think he already touched upon governance, and I think the key view that we had taken in the Nayak Committee report, which he referred to, was that usually governance aspects do not come to light when things are going well. But governance aspects come to light usually only when the going is not as good. As they say, only when the tide goes out, you actually get to see who's been swimming without clothes. So that view is important. I think we should keep that in perspective, because one often hears the comment that why do we need to change anything in the public sector banks, let's say, or even some aspects in private sector banks, because especially the public sector banks up until 2008, 2009 were doing really well. So, this is just a downturn, things will go back to, to normal again. I think that is something that we have to be a little careful about, that it's not just a cyclical, aspect. I think what we witnessed during the time of the sort of the banking problems, bank sector problems that we were manifested with, is that the governance aspects really need to be fixed. I think some of those governance problems are being sort of addressed, but my concern is that the institutionalization of some of those changes still needs to happen. So let me explain what I mean by that. For instance, this government has definitely showed the political will to let the public sector banks function independently without interfering on commercial aspects or sort of individual decision making, which is certainly something that's absolutely important. But let's be very careful, give credit where it's due, but at the same time also take a step back and ask ourselves, take a sort of a reality check on that this has happened because of the political will, but it's not been institutionalized yet fully, and that's where some of the recommendations of the Nayak Committee report actually need consideration, to make sure that this process of ensuring that the commercial, the banks are allowed to run commercially without, any of the previous phenomena of, again, what Dr. Ajit Kumar alluded to, phone banking, etc., which the risks are there if you don't institutionalize those, and that's something which is quite important. A second aspect on governance that I must, point out is that, especially when we look at our public sector banks, in terms of their the way the business, their DNA, we don't see enough variability, enough variation in them. Their DNAs do not look too different, to each other. So, for instance, sometimes, jokingly, I mentioned that, if you step into the branch of a public sector bank, you have to walk out and read the board that on outside to know which bank are you banking with, because they all look very similar. And if you look at the data in terms of their exposures tend to be very, very similar, if not same, but very similar. But in contrast, if you look at, take a Kotak, which is a private sector bank, for instance, tends to be different, actually has focused on retail lending. In contrast, our public sector banks look very similar, and that does economically also create some concerns, because you have, every time when there is a downturn, all our public sector banks get affected, to varying degrees, but they do get affected, and that is because they have become quite similar. And we also have to ask the question, that was that just a pure accident that the public sector banks have all become very similar? Were they all so similar when they were nationalized? And has there been, the process of the nature of ownership, has that contributed to, this sort of the banks becoming similar? And that's another aspect that we definitely need to think about, because as a sector, if the banks have different DNAs and specialize in relatively different areas, then as an economy we get more diversification, and that sort of puts the banking sector on better ground, being able to sort of ride over some of the the economic shocks that can manifest. Third aspect that I want to actually talk about in the case of, and whenever I've when I've been working on banks, the sense I get, when sort of deliberating with the banks, is that soft information and hard information, which is, so soft information is, things like those that cannot necessarily be quantified, where you, let's say, assess the character of the borrower, things like that. Hard information, of course, is, those that are quantifiable, those that you get from, let's say, the financial statement of the company, etc. The general belief has been, and that we've relied a lot more on relationship lending, which uses a lot more soft information. But more importantly, one has gotten the sense that our banks have viewed soft and hard information as substitutes, not necessarily as complements. But I think that is something which is very important for us to, and more broadly, what I'm therefore sort of thinking about is that our banks need to be using a lot more technology, in both being able to screen borrowers and also in being able to monitor borrowers. And now that is not to substitute the role of the loan officer, the soft information that the loan officer gathers, but to complement and thereby empower the loan officer in being able to screen and monitor borrowers better. And that is important. For instance, in my own research, I found that even aspects relating to the willingness to pay, I'm not talking about the ability to pay, the willingness to pay also can be, factored in. There are predictive factors, without going into details, that the willingness to pay also can be captured using the, quantifiable, measures that are there. So, in general, our banks have not been leveraging the power of technology as much as they can in enhancing the quality of their lending. And that is, especially given the kind of advances that are happening in fintech. We know of companies now that use just sort of, social media, to be able to give uncollateralized, unsecured loans to borrowers. Things like, information gathered from SMS, messages, etc. When we're talking about that kind of, the cutting edge of lending technology, I think there is certainly a compelling case to be made for significantly greater use of technology by our banks going forward, which will definitely strengthen the quality of their lending. A final point I want to actually mention, again, this is relating to governance, which is the vigilance function. Let's be very clear that any business itself involves taking risk, but in particular, the business of banking involves there is judgment involved, there is risk involved. And you will, invariably have some loans going, not doing as well, and that is because the risk that is intrinsic to the business. So, in an after the event, which is what we know economists call exposed to be equating bad judgment as malified intent, I think creates several externalities, and that is where the vigilance function, the robustness of the vigilance function, the fine nuance in the vigilance function is something that is extremely important. Every time that the vigilance function equates bad judgment to be malified intent, what it does, it is actually increases the risk aversion of the bank officials, because they will then say that if I can actually be hauled up for a judgment that I made, which turned out to be, let's say, to be bad, then even for good borrowers, I'll become once bitten twice shy, and that is part of what we are observing as well. Also recognize that this is part of irrational exuberance does happen, but irrational exuberance and malified intent are two different things. That's something which we have to be be cognizant of. And here's where something we need to be thinking about is that when the vigilance function is inside the organization, there is again soft information that one obtains, the loan officers may obtain in being, by talking, let's say, in the canteen or the restaurant and saying X is doing, active, Y kind of activity, which may actually not be possibly completely above board. that information gets lost. That soft information that gets generated within the organization gets lost when you have vigilance function being performed by organizations that are outside the organizational boundary. This is what economists think about as the theory of the firm question, which is in terms of the boundaries, how should the vigilance function be organized? And work in this area shows that vigilance is better off utilizing information that gets generated inside the organization. Of course, there are no benign options. You may have some instances where, because of excessive proximity, some friends and let's say may escape because of the function being internal. But overall, actually, if you look at in terms of the balance of the trade-off that prevails, the vigilance function being inside the organization performs a better task than it being outside, because crucial information is lost. So these are sort of some broad thoughts that I wanted to lay before you for thinking about governance in the in the context of our public sector banks. I think it's extremely important for our banks to be really robust and not encountering these speed breakers, that they basically sort of go at breakneck speed initially and then hit a speed breaker, and then basically the car is just halting for a long time. That phenomenon, actually, if we have to be avoiding, then emphasis on governance, I think, is extremely important. I once again thank Dr. Charan Singh for inviting me to share my thoughts. I wish the conference all success, and I would be very happy to actually learn about some of the key learnings from the, some key messages that may come from the papers. Would love to know more about it. Thank you very much.
I would now request Dr. Andreas. I think he's doing a PowerPoint presentation to make his presentation.
I apologize, I have to take leave, but wish you all the best.
Of course, again, thanks to the organizers for not just inviting me today, but also congratulations for this timely event. As of course the Vice Chairman of Aayog already mentioned, we all of us who are looking at public policies and economic and financial policies, of course, we keep a close eye on the banking sector, both because of its importance in the development process, but also given the stress that the sector has been under, and trying to figure out how we can help and how policies can essentially accelerate the process of healing of both the bank and the corporate balance sheets, and therefore strengthen the development role that banks play in a growing economy. So I wanted to focus today on something. There's many aspects to discussing the banking sector. Charan, I think, did a nice job in putting it all out. So I'm not trying to kind of put a little bit on everything. We sure have views on everything. We did together with our friends from the World Bank a financial sector assessment about a year and a half ago, 2 years ago. That's on our website and touches many areas. But today I want to focus a little bit on the issue of actually trying to resolve some of the stress and the issue of resolving stressed assets. And given a little bit of time, I will just start maybe from the international experience, talk a little bit of what we have seen around the world in terms of how a successful or a strategy should look like that has a high probability of being successful, meaning rehabilitating balance sheets in a fast and cost-effective way. And then I'll reflect a little bit of where we are in India from our perspective, and how, with that frame in mind, maybe how there's a few areas, next steps that we could do to support the process. So let me start just very quickly. I mean, the issue of stress on banking sector balance sheets and of large NPAs is really something that we've seen around the world in several vintages. I just put out a few episodes here, but almost in every decade over the last several decades, we have seen actually major cases, starting, including my country, Chile, in the 80s. In the 90s, we had, of course, Japan, but the Asian crisis as well. But even in Europe, we had a crisis in Sweden. We had also others that are not mentioned here in Eastern Europe. And experience was gained. And now, more recently, in the 2000s, of course, after the global crisis, we've seen a lot of stress in Europe, Ireland and Spain in particular, but even in other countries, in the US, but also countries such as Turkey. And of course, now we have India here. And public policy makers worry about this or get involved in this because having large levels of NPAs on bank balance sheets, they essentially lock up capital, they impinge on the credit function, they affect growth, and also from a monetary perspective, they block the monetary policy channel. So from a public policy, from an economic policy perspective, it is an important concern to kind of deal with this stress. Now, when we look at the experience around the world, basically in trying to distill the kind of the diverse experiences, and I will say that the experiences of how to deal with this kind of stress are very diverse, and of course they reflect also country circumstances. But if we try to distill that, and we've looked at a large number of cases, I would say that what the experience suggests is that to really overcome situations of high level of impaired assets and stress on corporate balance sheets, it's important to have a comprehensive strategy, and that generally focuses on three aspects. So it has three elements. The first one is really a tightening, or you could call it a modernization of the regulation and the supervisory policies and processes. This is the first pillar that you typically see. The second pillar that you have is a strengthening of the framework for asset recovery to kind of help that process. And then a third kind of pillar, or a third area of angle of attack of the problem is the issue of trying to develop a market for distressed assets as an instrument to help facilitate that process. And so for these three pillars, the key policies that are being pursued, or what is being done, is fairly clear. So on the supervisory and regulatory part, the issue is really to try to take steps to create a framework, a regulatory framework and supervisory action, and that one ensures first a swift loan recognition, and also that clearly leads to a fairly quick exit of non-viable borrowers. And that we've seen in many countries. You remember maybe Japan, the Japanese crisis, there was a lost decade in the 90s where very little happened because there was no decisive action really to recognize the problem, and this only changed once strict rules were put up to do a very rigorous cash flow analysis to classify the loans, and this is when the whole problem came to light. And many countries have applied certain procedures to try to triage out corporates, to try to find those fairly quickly who clearly are underwater and need to just very quickly get out of the way. Sweden, Korea have been cases like that. So this is part of the whole. This is part of the goal on this first pillar of supervision and regulation, and clearly the issue is to foster really robust provisioning, to timely write-offs, and really prudent income recognition by banks, so that we see where the problem is. Now, in terms of the second pillar, the asset recovery pillar, what we've seen almost across the board, a number of countries really large, is that they have significantly strengthened the insolvency regimes. And not just the judiciary regime, but often also put in place some sort of hybrid out-of-court frameworks and mechanisms that could help expedite the process of either restructuring or rehabilitation, or if the firms are not seen as viable, of liquidation, of course. And that we see it again across, especially during the Asian country crisis, but also in Turkey later on, and you see now in Europe as well. There's a lot of work in that area that typically happens to expedite and improve the process. And these reforms are often then complemented with some other steps also to improve the infrastructure. So moving to specialized courts, for example, in Indonesia, Thailand has happened, or removing some tax impediments or regulatory obstacles to recognizing losses as well. So that's a very important component that we have, and where we have seen a lot of action. And then the third aspect, the aspect of generating a market, really here the point is to try to facilitate price discovery of the underlying NPAs, which is always very difficult, and to accelerate really the removal of NPAs from the banking balance sheet. In many countries, AMCs have played a role, and I'll get back to that at the very end. But also recapitalization of banks, of course, is important. You need essentially for this process to take off on the sell side, you need to have the capital base to take a loss if necessary, to dispose of the assets. So these are the key issues. Now, if we look at India and we think about India, what we've done, what has been done so far in terms of the resolution approach, I think we'll see that we've seen action under all three pillars, in all of these three areas. I mean, there has been, I think, substantial action on the side of regulation and supervision, very important in 2015 when the master security of the RBI was updated, and essentially most of the forbearance that was granted for restructured loans was eliminated. But there were other subsequent actions continuously, including to improve provisioning levels of loans, especially those that now go through the new insolvency process. The AQR was of course absolutely key to foster and to accelerate recognition, and that really finally helped kind of put a flashlight on the problem, as I think the Vice Chair of Aayog also mentioned when the new government came in. Of course, there was subsequent action to empower the RBI to direct cases to the IBC, and in fact, the largest accounts have been referred to the IBC afterwards. And more recently, in February 2018, again, the framework was revised to ensure the early identification and reporting of stress in loan accounts. So there's a lot of happened there, and trying to accelerate that process to make sure that banks are on top of their exposures, and we view that generally as a very positive as a very positive process. In terms of the asset recovery framework, of course, there were all these different restructuring mechanisms the RBI had put out, but the passage of the IBC and then its operationalization has, of course, been the big step forward, with all the also the subsequent amendments that deal with willful defaulters and treatment of home buyers and others. So I would say a lot of structural change on the front of strengthening really the mechanisms for asset recovery, with some learning involved, especially with these previous schemes that the RBI had put out that were clearly very limited in scope, were mostly attractive for the forbearance that they were giving, and therefore not very successful. So I think there was also a learning process. And then finally, on the NPA market, maybe there a bit less progress. Of course, recapitalization, as I mentioned just previously, is very important for this market to get going. If banks don't have the capital to kind of sell an asset at its economic value, then they will hardly be willing to sell it. So the market cannot generate, and there's no supply. There has been a little bit of action on the regulatory side in terms of allowing foreign players to come into the ARC segment under the automatic route and with 100% FDI. But that's been probably the most important change we've seen there. Now, what are the remaining challenges that we see in terms of the NPA resolution. So I think one of the aspects where maybe not so much progress has been made is actually improving the in-house capacity of the public banks, especially to manage and resolve their NPA portfolios. There have been, one of the aspects is that, of course, there is, in this area, is not really a strict guidance or oversight from the RBI. So this is about really the NPA management. There's strict guides on how to recognize NPAs, but less on the side how to manage NPAs. I think the banks mostly have board-approved policies, but our sense is from the work that we did is that these policies certainly have scope to be strengthened. And so building that skill set within banks in dealing with these with problem loans, I think that is a work in progress. There is expertise out there, but also it seems the banks don't seem to be able to bring that expertise, that external expertise into the banks. And the other issue, I think the Chief Economic Advisor mentioned also, there is still this fear of vigilance, of second guessing, that is a deterrent for officials of public banks to really move ahead, and it tends to lead to a judicialization of the workout process. So it's always more comfortable to send it to the courts and let the process work out there than rather being proactive and doing it outside of the courts. And that is a segue to, I think, the second point is that the strategy to address the non-performing assets is really it is put all the money almost on the IBC horse. It's a good horse that's running, but this carries a risk, and the risk is that that really the system might be overburdened. And remember, our kind of the implementation of the bankruptcy code is a work in progress. The infrastructure is being built while it's almost like you set sail of a ship while you're still building the ship. So so there is some concern that that the system is under strain, and in fact we do see that the very ambitious time limitations that were set under the IBC really don't seem to be complied with. So that is a second concern, and I think the third concern again is that the market for stressed assets, the private market, has been really very slow to gain traction, and only recently there's been some pickup in NPA sales, but we do see that especially specialized investors and foreign investors who have the expertise, financial investors, are really not coming in as much, and I think that part of the reason for that is the regulatory burden. So to finish it off, we want to reflect it just a little bit about what else could be done. What are the next steps in the process that could be contemplated to accelerate the process, but also to build a stronger system going forward. So I think the first item to mention here is really that we think there is room for more oversight and prodding on the NPA management function of the banks. So the way how banks work out their loans. There is scope to actually for the RBI to look at the banks, how they to assess the management capacity, the NPA management capacity of the banks, to issue some guidance on NPA management practices, and then also to help banks strengthen their NPA management plans and include their also operational targets against which then they would be evaluated. This we have seen has been quite helpful in other countries to try also to prod banks to be more proactive, along with, of course, other steps that we mentioned, such as recapitalization, to allow them the financial buffer. Second issue, I think, again, CA mentioned this, there is a need to protect bankers in restructuring negotiations from liability for bona fide decisions. So there clearly, I think, is a necessity to add to the banking legislation and shield officers that act in good faith and follow procedures and really just take decisions in the best interest of the institution, even if ex post that means that the institution suffers a loss. So these are measures in the first pillar. For the second pillar, for the issue of improving the restructuring the workout mechanisms, the toolbox, essentially, we do still think that there is a need to establish an effective out-of-court restructuring mechanisms. What we do see around the world, and has worked often well, is some sort of hybrid approach, not a fully kind of voluntary out-of-court process, but a process that has some formal elements to give it a judicial certainty, but does not require to go through the whole judicial process. And basically, I mean, you may have heard the word of pre-pax. It basically means that you have a process where there is some formal intervention at the beginning, mainly to provide a standstill that gives creditors and debtors to have a negotiation, and then at the end, but go back at the end only with a kind of pre-agreed solution to the judiciary system and get this approved, and this step then allows also to bind creditors that may not voluntarily agree, provided that there's a sufficient supermajority out there. So clearly, I think this is something that could be considered to complement the current IBC framework. It is helpful because it provides often for a much faster resolution. It also provides for lower cost resolution, and it then really eases up capacity at the tribunals to focus on the very complex and difficult cases of insolvency. There is, I think, a work in progress, and much of this is already in the pipeline, but I think it needs to continue to strengthen the infrastructure, the framework of the IBC. One concern is resources in the tribunals itself, including creation of more benches. I think that is in the pipeline, but it should continue. The same goes with deepening capacity building efforts that are there. And there are, of course, some elements still missing, especially information utilities that were part of the framework. And we do see with some concern that the cases in the IBC often take a long time from being referred to actually being admitted. And there clearly, of course, data is a big issue. Finally, for ARCs, I think there is scope to improve the operating environment. In many countries, what we see that have a more vibrant market, the task of dealing with NPAs in the private sector is actually split. We have a fragmentation, so we have a financial investor who really just puts up equity to buy a portfolio. And that's a purely financial decision, financial investment decision, where there's very little risk. There's very little kind of protection needed for any investors. These are kind of more private equity type mechanisms, and they should be very lightly regulated. And then there is some other actor who will actually service the loans and will try to work them out, and they require some regulation. But here, both in India, both are together, and they are under very strict regulation, like NBFCs with high capital requirements, with concentration risks that make it difficult for a private actor to take on some of the big accounts. So I think in general there is scope to make a more conducive environment. Finally, always the big question is that comes up regularly is the question of an AMC or a public AMC or a centralized AMC. I think the experience we have around the world is very mixed. They have certainly been helpful and worked well in some cases. But they really are also very costly to establish, and so they require a fairly large scale to be efficient. They work best when you have fairly homogeneous loan portfolios, so it's really about economies of scale. Often in cases where you have lots of real estate exposure, mortgages or collateral involved. less so really when you have corporate exposures of very different companies. And a key aspect of this is really for AMCs to work has been operational independence. So they really have to operate at arm's length from the political process. Otherwise, success is very difficult. Now, looking at the Indian case, I think on balance, our view is we've not been advising this step. Basically, we think it's the instrument itself is probably less suited given the heterogeneity of the loan portfolios with cases that really require more of a private equity expertise to deal with them rather than just a standardized kind of resolution process. The largest cases, moreover, are now already in the IBC, so in a way, again, the scale problem would come up for anything else you want to put in there. And of course, I think the challenges regarding governance and expertise would really have to be bridged in a credible way to make it a useful instrument. I'll leave it here. Thank you very much.
Marius.
Thank you very much. I'd like to thank Dr. Singh and the EGROW Foundation for inviting me to this conference. It's a pleasure to be here. I have a presentation also that could come on the screen. Thank you. I'm Marius Vismantas. I'm with the World Bank. I've been working on India for the past few years, and one of the things that I did, as Andreas already mentioned, I co-led the diagnostic exercise of the Indian financial sector a couple of years ago, together with colleagues from the IMF and the World Bank. So I'll focus a bit on that and share with you some of the findings and some of the additional policy considerations that I find would be useful for this conference and this audience. Just a little remark that these ideas are of my own and not necessarily the World Bank's official position. So the structure is basically 4 key points. It's the findings of the FSAP, the Financial Sector Assessment Program, a bit on the ongoing challenges, special focus on development finance, which has been alluded to already this morning, especially by Dr. Kumar, and what I call a grand bargain, and I'll explain what I mean by that. So the FSAP is a comprehensive diagnostic of financial sector that the World Bank and the IMF do in all countries of the world. We go into financial sector stability issues, we go into financial sector development issues, and we sometimes do assessments against internationally agreed principles in different areas of financial sector, and we provide recommendations to our counterparts, which are usually the Ministry of Finance and the Central Bank. So what came out from the 2017 FSAP is basically that financial stability was adequate in spite of the NPL issue. Capital needs of the banks were manageable under different stress testing scenarios, that there was a robust financial sector oversight developed and continuously improved by the RBI. There was an oversized role of the state and financial sector leading to certain inefficiencies, and I'll go in a bit more detail into that. PSL, the priority sector lending, we thought could be eventually phased out and replaced with more incentive-based instruments. There was a lack of modern bank resolution regime, which I think still continues to be the case, as the law which would have been introduced, such resolution regime did not pass last year in the parliament. There was obviously an inadequate supply of long-term finance, especially for housing and infrastructure, and the existing models were not truly sustainable. And there was, of course, a very strong progress on financial inclusion, with particular reference to the Jan-Dan accounts, which of course have a challenge of being operationalized and used more, but this has been a great step forward. So these were sort of a set of key things that came out. Just a few highlights. So one of the recommendations was that the future footprint of the public sector, the state, could be rebalanced away from large bank ownership and directed lending towards better leveraging the existing public capital, which is in the banks, and incentive-based solutions. And among the recent actions, I took to quote the Minister of Finance, who said that India needs fewer and larger banks, and this was repeated by Dr. Kumar this morning, that economies of scale need to be brought up, and that would serve the system well. And again, as a practical manifestation, we've seen the ongoing PSD merger, starting with SBI and then Bank of Baroda and others. Another was that the future capital injection by government of India in any public sector banks could be made contingent upon the restructuring and consolidation. And that was done, we said that 2 years ago. Then the government still had the Indradhanush plan, which was active at that time. It was providing capital to the PSBs, and eventually it was replaced and taken over by the 2017 recapitalization package. We thought it was a good time for the government to sort of take a deep look at the universe of public sector banks and say, how can we manage them better as a group, and what could be ways forward which maybe would require less capital or more efficient capital allocations. And again, recommendation was, and the discussions were also focused on different types of mergers. And again, the manifestation of the action is that some mergers have started, and probably others may happen in the future. And the recap program is also in full swing. But I guess the point to be made here is that there was a lot of front loading of capital. Capital was basically provided to all PSBs. And especially to the PSBs which ended up in the corrective action program. In some sense, maybe an opportunity to do a more deeper restructuring and perhaps a more faster merger was a bit lost, but it continues. And again, related to that, we thought the exit of the weakest banks via sale of assets or to other banks should be. It's all about recovery values, because what the government, what the public sector banks have paid, so to say, for the NPAs, a part of it can be recovered with strong recovery efforts, and that's where the focus should be. On the recapitalization, it's been a cost. I take note of Dr. Kumar's point where he rightly said that there have been no casualties, and India has gone through this latest round of non-performing loans in a sort of a mini crisis of its own without banking casualties. But as economists know, there's always a cost to everything. So in this case, the cost was the recap, which is a budget cost, which is a fiscal cost, which is a cost to taxpayers. Again, to reduce the cost, the resolution of NPAs should be done as effectively as possible. I think there's still a bit of a fear of a negative impact on economic growth and development if the banking sector continues in this low lending equilibrium, where loans issued are not in volumes that could be otherwise. And again, the point was made that Indian credit to GDP is only 50%, so there's a lot of way to go in the future. That's a good thing, but again, growth does depend on lending. And lending has to resume one way or another. And as I say, it's a bit of a fiscal and political economy issue rather than banking sector stability. Stability, as long as banks have capital, that's fine. But in order to spur growth of credit, With the banking sector as it is, largely owned by the government, it is to quite a big extent a fiscal issue. More capital to the banks, public sector banks, more growth can be expected in credit growth. Which brings me to the last point, the last challenge, which I think is the biggest one going into the future, especially, and this is the theme of the conference. So what the financial sector, in terms of financial sector pillars, what are going to be the most important ones to sustain the growth of the economy? And the question is, the questions are, is it going to be led by banks or non-banks or capital market? Is it going to be, largely domestic resources? And we heard about the high savings rate in India, but could external resources also add to the development and the growth? And again, the big question from the World Bank's perspective in particular is, what is the optimal role of the public sector? And I'll go into a bit more detail on that. So one special focus that came out from our diagnostic of the financial sector, and I think it is a big issue for the future, is what we call development finance. Now, mind you, the World Bank is a development finance institution, and we know the value of it, and we do advise governments on how to develop the development finance in different countries. The question is big in India, because the needs are big. I mean, there have been various amounts mentioned through years of what development finance magnitudes are, and they go into trillions of dollars for the next 5, 10, 15 years for infrastructure and everything else. So the needs are huge, so the focus is also large. Then I say development finance, and when I think of India, I see a bit of a fragmented approach. It's not just the banking sector that is fragmented between large and small institutions, government and privately owned, but it's also the development finance approach from the government's perspective is quite a bit fragmented. So what we have policies, of course, the government is in charge of policies and in charge of regulations. Then we have fiscal incentives, like interest rate subsidies of sorts. Then we have development budgets in the union budget, in the state budgets. Then we have ownership of banks, which is a development finance instrument. It's used by the government to direct funding somewhere to the economy where the government wants it to go. What I call financial repression is the priority sector lending. It's a directed credit program, which is again another instrument in the hands of the authorities to direct credit where the authorities think credit should go. And I haven't listed all of them. There are a small savings scheme, and there are large and small development finance institutions of the government. So there are lots and lots and lots of instruments and tools and schemes that the public sector is using to direct finance. Now that could be made more efficient, I think, and a holistic view could be taken to sort of look at all of those instruments as one big whole and see how the capital from the public sector is allocated and how effectively development finance is delivered. So there's a whole theme of development finance. A few years ago, there was this important agreement framework in Addis Ababa on development finance. One thing that came out of it is a thing called Integrated National Financing Framework, which basically is a tool for any government to say, okay, let's take a look at how we deliver finance to the economy, and let's try to make it as efficient as we can. So this is something that could be thought about. Again, one important aspect of development finance is that public resources are always constrained. They're always limited, especially in emerging, growing economy like India's. So the trick is to leverage the funding as much as possible. You may have heard about the maximizing finance for development approach that the World Bank has been spearheading a lot. The idea is that you take public finance, whatever it is, and you try to maximize public sector contributions to it. Build platforms, build blended finance pools, which which could be used for development, for whatever, for infrastructure, SME, agri-lending, whatever development needs are. So that's a big issue all around the world, and I think in India there's a lot to think about how to do it better. And the last point here on this slide is that effectiveness is paramount. How do you do it most effectively? And being in the financial sector, I would always say finance is good, but it's not the most important thing. In order to direct finance efficiently, you need knowledge, you need capacity, and that brings me to my other points. How do you build that knowledge and capacity? And so the future of Indian banking, to respond to the theme of this conference, is basically a function of the future of the public sector footprint in the system, which is large now. It could be made smaller, it could be made more efficient, more effective, and I would argue that one of the key priorities for the government is to optimize the cost of maintaining this presence in the banking system. Now there's a trick between optimization and minimization of the cost. Minimizing the cost does not mean that it has to be the most critical driver. It's the optimization. It's keeping the cost at the level where development objectives of the government's participation in the financial sector are achieved, whatever they are. And that is an important policy issue. So, and it is a difficult political economy issue, mind you. So that comes to the point of I mentioned earlier on the grand bargain. India had public sector banks for 50 years, so it's ingrained in the system that government is behind not only the banks but the entire system. I think we heard early in the morning that the government backs 70% of the banking system explicitly and 100% implicitly. Now that comes with a cost. That gives stability, that gives peace of mind to the population, to the users of the banking sector, but that comes with certain costs. And what could be a grand bargain in this case? There have been on and off discussions on different grand bargains, and by grand bargain one means an important reform of the sector. I would offer my take is that if the government decides for efficiency, for optimization perspective, interest to reduce its presence in the financial sector and divert its capital in different ways, it could offer, instead of its implicit and explicit backing of the system, stronger deposit insurance, which can work just as well as the implicit government backing. It can offer much larger development finance flows through different instruments. MFD in this case stands maximizing finance for development, which I mentioned, which could go through development finance institutions and guarantee schemes to all the big developmental areas. And of course, it would be important to reskill thousands of public sector bank employees if that is going to be a need. I would stop for a minute on the DFIs. Dr. Kumar has made a very interesting point about the history of development finance institutions in India. The history is long. I read a bit about it. To my interest, I realized that in 1955 the World Bank was behind of putting one of the important development finance institutions at that time, and that was ICICI, which later became, of course, a private commercial bank, but the history goes back long. In the early days of our existence, we were part of creating such development finance institutions in different countries. Now, in India, you probably know the history better than me. The DFI sort of fell out of fashion at some point. I would argue that they should be back in fashion. They have a role to play, and a big one. And if we think about this big concept of development finance, how to direct money most efficiently by the public sector, I would find few other institutions better equipped than well-governed DFIs. DFI sector around the world is littered with bad examples, wrongly governed development banks which finance wrong types of white elephant projects and so on and so forth. But there are good examples, and they've worked charms in different countries. And I would argue that India can do much better with DFIs. You have DFIs already. There are national level DFIs. There are state level DFIs. National level, I mean, the likes of National Housing Bank and SIDBI and NABARD and Mudra, and there are tons of others. The government has $130 billion invested in PSBs, but only a few, or at most several $1 billion of capital invested in DFIs. And I would say that balance should change, going from the commercial sector, from the PSBs, more into DFIs in the future. And I will leave with a quick recap. The grand bargain comes with a grand challenge. So building a financial sector capable of supporting India's aspirations for a high middle income country and high growth is of course most important, requires a clear vision and strategy, and requires resolution of important political economy trade-offs, which of course are not easy, and figuring out the correct path on development finance. I find it's very critical in this case. Thank you so much.
I'm sorry we are running a little late. I'm the last speaker on our panel, Ajit Pai.
Yeah, good afternoon, everyone. What we're going to try and do today is actually provide a perspective on Indian banking and provide a sort of context in terms of both time as well as in terms of structure of supporting the credit needs of the economy. So hopefully it addresses some of the issues that have already been brought up. But this is just in terms of, it's more of a diagnostic than providing recommendations. And hopefully the ideas will come from all of you in areas that we can explore. So Indian banking in perspective, credit support to the Indian economy is what we have titled it. And as we go through these slides, you will see the context that we are placing Indian banking in. So in fiscal year 14, you'll see that about 70% of the sector for credit, private credit, was the banks, the scheduled commercial banks, that's both public, private and foreign banks operating in India. 18% was corporate bonds, 11.6% was the NBFC industry. One thing I want to highlight in these two slides, this one and the next one, is that we have taken some not artistic liberty, but analytical liberty. So you'll see that the numbers are overstated in terms of total credit outstanding, and that's largely because we wanted to highlight the relevance of corporate bonds. About 2/3 of those corporate bonds are actually from the financial sector, and so more than half. And so that actual overall number that you see down there would be reduced by that much. So proportionately, NBFCs as well as the banking sector have been shown slightly lower than they would have been. But that's more to highlight that the corporate bond market has not come of age and should. So you can see the change over here. Doesn't seem like much between fiscal year 14 and 18 in terms of the balance of the sectors. But if you look at it in terms of incremental credit, which is the new credit that has come into the market, you can see that the contribution from almost a quarter from the corporate bond market and from the NBFCs has grown to about almost half. So a large part of the new credit, has been coming from these sectors. They're becoming importantly relevant. Now I can say that going into fiscal year 19, you'll see a slight reversal here, but the long-term trend overall, we hope, and as we go through slides in the future, is going to be much more balanced. So the way we would refer to it, I think we've seen references to pillars of different strategies, by the World Bank and the IMF. We are looking at these three as three legs of the credit stool to support the Indian economy. And focusing only on one leg, doesn't matter how strong it is, having two thin legs on the other side can actually, with any weight on top, it could break. So we need some balance there. We all recognize that banking is the most important aspect, and that's because it's the most secure and should be the safest and the most closely regulated. But to meet the credit needs of society, we actually need these other two legs to be working quite well as well. So just to place things in context, we're going to show you the overall credit from banks, net of NBFCs and corporate bonds in the economy, what it has been like over the past several quarters from March 2012 onwards. That blue line over there indicates what nominal GDP growth has been. And you can see that credit was growing much faster than nominal GDP, went below went above nominal GDP, in which case it's supporting the overall growth of the economy. But very recently, it's actually been lower than nominal GDP. Diving deeper, you can see the corporate bond market. It's a market that has rightly been pointed out has not come of age yet. A large part of this is that the vast majority of the 6,000 companies that you see, or over 6,000 companies in India, are not yet of the scale to support the corporate bond market. But this is, it's a very robust growth. It's coming of age, and I think the next 5 years should automatically see many, many more Indian companies and many more Indian financial institutions reach that critical mass and start becoming, increasingly eligible for raising corporate bonds at a reasonable rate. So that is a very positive sign. You can see the very firm growth rates. It's been growing significantly faster than nominal GDP, but it hasn't come of age yet, and that critical mass should be achieved in the next 2 to 3 years. Looking at HFCs, you can see that the very robust growth over here over the past 5 or 7 years, accelerating growth till fiscal year 18. You're probably going to see fiscal year 19 as a sharp deceleration. You've probably been seeing what's happened in the asset liability mismatch even in that industry. But these agencies have been showing very, very decent growth the past 4 to 5 years and becoming relevant to the overall credit structure. Similarly, when you look at NBFCs, more than 10,000 NBFCs in India, though the vast majority of the credit is only about 130 of them. You can see that the growth has been very robust. But again, over here, you can see that while they've been growing much faster than normal GDP and helping, they are also going to see a material slowdown. September 18 marks the IL&FS sort of takeover by the government. So we don't have the December quarter numbers yet, but I could tell you that there's going to be a material slowdown there. And then going forward as well, that will be much more controlled. So this comes to why we saw so much growth from the NBFCs, HFCs, and the bond market. And that's because the growth, the orange line over there, shows you the year-over-year growth rate of lending, advances, from the basically the scheduled commercial banks, all segments of them. And you can see it decelerated very sharply from 25% growth, much faster than nominal GDP, all the way down to lower than 5%, which means that it was actually negative for a while in real terms. This is nominal. It did begin accelerating in April of 2017. That was marked the low point. But it only started becoming accretive to economic growth, means growing faster rather than a drag. It only started doing that in the past 6 months, since September of 2018. So if they're making loans right now, it's much less than they should be doing. And so this credit growth is very, very healthy, robust growth, and much higher quality growth than the sort of profligate lending that happened in the sort of late 2010 and early 2011. This is just showing you about 3 sectors. We're not going to cover all the sectors that banks have been lending to, but to show you that one of the biggest employers in the Indian economy is industry. After agriculture, it's and construction is the 3rd largest, and relative to infrastructure, it's actually even larger. You're going to see that this sector has suffered a lot because of the banks not being able to lend, and HFCs and corporate bonds not being able to support it either. So this is a sector that you have to pay close attention to. Even today, the lending to industry is still almost zero when you look at it in real terms. In nominal terms, it has begun to accelerate, but way, way below nominal GDP overall. And this is an area we have to figure out what we can do. We've talked about the developing financial institutions. We've talked about the other institutions, but we've got to figure out what we can do here, because this is where a lot of the employment of the country is. Bank credit to the infrastructure sector, which has hurt the most, you can see it was a negative territory for a very long time, is finally growing again. It is not yet accretive to GDP, but at least it's positive from being negative over here, and it's been one of the worst hit. The green bars you can see at an absolute level, we're just reaching the levels of about 5 years ago in terms of absolute outstanding credit over here. Bank credit to real estate has also picked up recently. It's beginning to accelerate. That's a healthy sign for the real estate market. There is still some excess over there. There's still some restructuring going on, but the underlying improvement is already there, and we are actually seeing some segments begin to do quite well. This is the sector that has been actually supporting bank credit growth the most. It's the personal credit. People thought that this should be a big concern. I'm sure all of you are getting calls to take loans on your cars and secondary loans. But this is what has actually supported a lot of the economy in the near term. And right now, it's a good sign that the other sides are beginning to catch up. And this is not accelerating, it's decelerating, which is personal consumption is going down. So this slide shows you on a relative basis, the blue line is nominal GDP growth. So you can see that what's above it is actually supporting economic growth by being faster. And what's below it is actually a drag on economic growth. So credit to infrastructure and industry is hurting, and credit to real estate and personal loans is actually helping right now. Moving on to the structure of the banking industry and some longer term trends. This was, so far we have just placed the banking industry overall in context and provided some idea of the main areas where things have been good and bad. The scheduled commercial bank assets, if you have a look at them, the right on top are the foreign banks. You can see overall, the foreign banks have not been investing in the Indian sector. We can discuss reasons why, in a later session, not as part of this. You can see the private banks have increased their contribution from 18% to 28%, 1,000 basis points increase in about 15 years. And then the public sector banks have, reduced their contribution to only about 2/3 from what used to be 75%. So naturally, you're watching what people have referred to as the public sector banks gradually sort of losing their influence on the overall credit markets, but still being very, very significant. So, looking at this not from an assets perspective, but credit outstanding, from the scheduled commercial banks, you can see in December 72 the absence of foreign banks. You can see only about 16% was private banks. You can see in 80, you watched a slight increase. 90, actual drop for the private sector banks, increase for public sector after the next round of nationalizations. But by 90, you can see that the foreign banks are becoming quite material, huge potential in India that they're looking at, but they've stayed there. As you go through, you'll see that the private banks over the past 30 years, the big story has been that of the private banks since 1990 till today have shown the greatest amount of growth overall out of the scheduled commercial banks. On the deposit side as well, it's a very, very similar trajectory. That the vast majority of deposits having been with the public sector banks is now, you can see that the private sector banks have been taking a large part of that growth, have been growing much faster. So the scheduled commercial banks, the assets in India have seen decelerating growth after the global financial crisis. So part of this, and in fact I think a lot of people have referred to it overall, that with a very robust structure and oversight structure in India, whether it was actually a mistake for us whether we've been overly conservative, and the Indian banks could have grown much faster because we were way behind on the credit penetration cycle, something that we look at later. So we have been overly conservative and actually choked our economic growth by responding to things that happened in over-leveraged countries, by responding to that with overly strict standards in India. So you can see in India itself, the growth in assets of the private sector has recently been stronger than the other two groups. So it's been, very, very robust, the middle green line. And the growth in credit from the private sector has also been more robust than the other two categories. So this is a positive sign, according to us, because a much higher return on invested capital and more efficient allocation, as we will see. When we look at growth in deposits, also we have shown you that big change, but you can see the growth rates. It's been much more robust and continues to be robust. And then we start looking at, what is the actual composition and where are the three different sectors playing. And over here you can see, where most of the assets are deployed. And you can see that foreign banks in India discount more bills and provide less in term loans as a proportion of advances. So it's a much more balanced sort of structure than the others. And unsecured advances are much greater, so foreign banks actually think that they do a much better job in assessing risk. They're giving much more loans in terms of unsecured assets. And you'll see in a short while, it hasn't hurt them. But this is the structure of the overall banking industry, where over 80% of the assets, so 81% of the assets and 82% of the advances, are controlled by the top 20 scheduled commercial banks. So it's a fairly high concentration. The number of scheduled commercial banks, they are right now at about close to 90. Close to 90, but 44 of them are foreign banks with not too many branches in India. You can see that in terms of offices, the private sector has been growing much faster than the public sector. So just go through a couple of recent metrics in terms of profitability, just showing you that the return on equity is been the highest for the foreign banks. The net interest margin is one area I want to draw your attention to, whether for the foreign banks it's significantly higher, private sector banks, and then the scheduled commercial banks, it's over 4%. The foreign banks on multiples of the profit per employee is also significantly higher. They are more than 2x the advances per employee when you measure that within India. And then the public sector spends the most on staff costs as a percentage of their net interest income. It's about 44%. Staff costs as a proportion of total assets is the highest, about 20% higher. And then the average size of credit size is also, you can see, significantly higher for the public sector banks and foreign banks. The private sector has been focused on smaller. We are now just going to look at the structure of the banking industry in terms of the G20 nations, the lending share of the top 3 banks. In each of these countries, you can see that India is actually the highest of the top 3 amongst China and the United States. And the number of banks, you can see the United States and China are still significantly higher than India when people question the number of banks that should be there. So here you can see India, China, and the United States from a structural perspective. You can see the top 10 banks are the ones that are shown. It's much greater in India than for China, and then the US is the least because the greatest number of banks. And this is the comparison of the net interest margin and bank lending rates across the G20. This is for 2017. So you can see India has the highest representative bank lending rate out of most countries, Brazil being the exception, and a sort of average net interest margin. This is the slide that we're referring to in terms of credit to GDP for BRICS nations, which is India, you can see, is the lowest out of all of them in credit. This is private credit to GDP. We're only at 56%, substantially lower than all the others. And you can see China, a lot of the growth over the past 5 to 7 years has been fueled by its credit. So we can't forget that. And then India over here again is the lowest in terms of credit to GDP and bank credit to GDP. So you can see the banks are the most significant part of the credit structure in these countries. And you can see India versus the US, in terms of the banks as a percentage of the overall credit, are very similar. But overall, the United States is more than 3.5 times the overall credit as a percentage of their GDP. So the other sectors, the other legs of the stool are very, very strong. We're looking at it across the board. You can see India's debt is very, very low, except for a cash-rich country like Saudi Arabia that doesn't require it. So we can just move very quickly to speaking that the credit to GDP and GDP per capita are highly correlated, and that the branch reach in India, we can just look at where the Indian banks are in terms of total assets, which is, as the VC pointed out this morning, State Bank of India, which is the largest Indian bank, and double the size of the next largest bank, is at number 60. So there's something that has to be done over here. And when you look at it in terms of lending, we are, of course, number 38, the State Bank of India. We also want to just briefly look at what's happening with the electrification of banks, which are, of course, as we go more electronic and digital, you're going to see that the growth rate of all the new technologies is increasing. So this is just to draw your attention to what the bank of tomorrow might look like. You can see right now what the tremendous growth in electronic banking has been in electronic transactions. The growth rate is still progressing at 300 to 700%. So that sort of makes for a different kind of bank in the future. You can also see ATMs have stopped growing since the beginning, for a very long time, and so that marks a pretty interesting inflection point where point-of-machine sales have also been growing strongly, reflecting what could be a changing banking structure. Card transactions also have been increasing significantly with all the formalization of the economy, and credit cards are growing at a very healthy rate. So with that, I think we are done with this.